Let's bring you this story now. The prime lending rate at banks is now 0.25% higher at 7.5%. The Reserve Bank hiked interest rates, warning that higher food, fuel and energy prices will keep inflation at a higher level. According to the SARB governor, Lesetja Kganyago, economic and financial conditions are expected to remain more volatile for the foreseeable future. Let's get more on this from Debt Rescue's Annelien van der Poel. Thank you very much for your time this morning. I mean, we take for granted the implications of a move up of the interest rates by the Reserve Bank, and we really don't think about the overriding implications it could have on a South African consumer who has debt. So maybe just break that down for us.
Well, I think the important thing for us to understand is the moment that you have any form of credit, so this would be a personal loan, your home loan, your vehicle finance, your store cards, anything to that effect, where there's an interest rate factor connected to it. Any change in the interest rate by the Reserve Bank directly affects the interest rate that gets charged by your credit provider to you. So we feel the direct impact immediately based on that. But then, like I said, we always have the indirect impact because it always inevitably flows through into the cost of general goods and services that we use and purchase, etc. as well. But direct effect, if you have any form of debt, that is where you're going to feel it immediately.
Right. I mean, could this be enough to put consumers or to push consumers over the edge? Over the last 2 years, Annelien, consumers have dealt with a really, really difficult time. Many of them losing their jobs, many of them getting fewer wages and things like that. So this increase, which is quite substantial for many, could it push people over the edge in terms of being able to stay afloat and manage their debt?
Absolutely. What we've seen in the past, give or take 2 years since the pandemic's impact has started filtering through into the economy, is obviously we did see interest rate reductions, which helps a lot when you have the other impacts on salaries, etc. But the reality is now, with the interest rate going up, we're seeing our debt costing us more. And a lot of people have had very little choice, but during these times where there's been income uncertainty, where they've actually had to incur debt just to keep, paying their living expenses, buying food and the likes. So suddenly now we not only are incurring debts to cover necessary living expenses, but it's also going to cost us even more than what it already has in the past. So it's got quite a severe snowball effect. And the reality is most consumers have cut their budgets, have made adjustments, have really tried to make sure that they're still able to cover their necessary expenses. But realistically, this is definitely going to start having an impact. And the reality is we're expecting potentially more of such increases in the next year or two.
No, absolutely. Annelien, if you could just give us a sense of how many people or how many more people have been knocking on doors like your institutions for help. Has there been a significant increase in that?
Indeed. We do generally also see a lot more inquiries come through in, January after the holiday season, where the festive spending might have also had an impact on a consumer's budget. But definitely, I mean, there's a marked increase this year, and it's definitely a situation of consumers who have tried their utmost to make ends meet and have made changes. But realistically speaking, it's just not possible anymore. And I think this interest rate hike is just going to worsen that even more.
Yeah, and I suppose what's worrying is something that you alluded to a little bit earlier on in our conversation, in that consumers are now taking out debt just to meet their living expenses. This is a problem, Annelien, and I want you to explain to us why this is an actual problem of taking debt or paying or using your credit card to buy your groceries and things like that. It's not a smart thing. Even if you don't have the funds, you probably should be avoiding that.
Well, definitely, and by no means am I saying it's always possible, but realistically speaking, is the significance of a budget here is so critical to try and avoid getting into that situation, because the moment you start buying consumables on credit, for example, food, you're going to be charged interest if you don't pay it back within a certain period of time. If you're having to incur, for example, a short-term loan, where you take out the loan in the middle of the month and you pay it back at the end of the month, you're going to sit with a situation where there's an interest impact. And every single time you do that, your you borrow X, but what you're repaying is X plus the interest. And at the end of the month, you potentially are paying it back, but now you've already on the back foot because of the fact that you've had to pay that interest. Next month, you do it again. And that's where the snowball effect comes in, because it just becomes more and more and more expensive in the long run, because you have this interest that keeps adding on in the background and just makes your living expenses even more expensive. And it's definitely, I mean, there's no asset value in buying consumables on credit. So it's definitely a very, very risky path to start going down.
No, absolutely. Thank you very much for your time this morning. Annelien van der Poel joining us there from a Debt Rescue, telling us about the state of the consumer and really some of the issues that come with interest rates hikes like we saw last week. Thank you very much for your time this morning.